Hey traders, Raghee here. Welcome to the Raghee Report. Great to see everybody. I was watching the end of the Niners-Eagles game, and that ended up being a bit of a blowout, but looking forward to that Bengals-Chiefs game coming up. And we're kind of catching that little gap in between the games. So let's get to it. I want to take a quick peek at what's going on with the economic calendar. That's going to be a big one this week, gang. So let's open that up. Let's take a look at what we've got there. Because ultimately, a lot of what we're going to be thinking about, what we're going to be reacting to, what we need to be aware of is going to culminate with sort of it's not as important as we would think, but it's going to be incredibly important in terms of the press conference. And that is Wednesday's Fed funds rate, FOMC press conference, FOMC statement. The expectation is for a 1/4 point hike. More so than that, though, the statement and the press conference are really going to be where that Wednesday action is at. And that Wednesday action is going to be all about whether or not we are about one, maybe two meetings away from that peak rate. In other words, here's a February meeting. We are widely expected to peak in March, and that's going to be at that 4 3/4 to 5%. Whether or not we then hold until the eventual cuts come, whether that be November, December, or early 2024, the bottom line is the next two, forget February, the two meetings after that are about as important as it gets, because ultimately this is where, quote unquote, the top for rates is expected to be, according to the Fed Fund futures, and reflected in the data that we know so far, reflected in the messaging from the FOMC that we're familiar with. Normally, I'd say the ISM manufacturing PMI would be a pretty big number. We would categorize that under something more with inflation. But ultimately, ISM, the JOLTS job opening, and really anything that comes before that Wednesday hot zone, CB consumer confidence, and on Monday, it's a pretty quiet day. Those are all going to fall second to whatever it is, not that the Federal Reserve is going to do, but what are they going to say? And that press conference is going to be huge. We'll definitely keep an eye on that. I will be for that hour on Wednesday, 2 to 3 o'clock. I will be in the options room and in the Sector Secrets Mastery on Wednesday, February 1. So if you're a member of the options room and you want to get a good idea of what macroeconomically we can look at, bonds, euro, of course, the indices. We'll take a look at the Fed Fund futures and see if what the statement and what Powell says during the presser is aligning with what we're expecting on the Fed Fund futures, or do we see a significant adjustment to perhaps the 5 to 5 1/4 column increasing in size going into March, going into May, maybe even June? That's going to be a huge meeting. And we're certainly not guaranteed, well, not guaranteed anything. We're certainly not guaranteed to peak in March or May. There's a pesky 1/4 point hike that's not disappearing from the conversation. It's kind of lingering, and that's the one that would take us just over 5%, 5 to 5 1/4% for ultimately that peak, or what they call that terminal rate. All right, so that is what we have coming up, and pretty much anything other than that is going to be a distant second. Now, of course, we have earnings, but many of you who have followed my work or follow at least my opinion know that I really don't think earnings are as important as we all think they are. Their volatility, cool, but they're not as important as we think they are from a trading perspective, right? So I've never seen a stock completely upend a trend and start going in an opposite direction in a way that was earnings only. There was usually a vulnerability before earnings, maybe a vulnerability after. I don't believe earnings in and of itself upends anything, and certainly not the indices. Volatility, absolutely. Lots of potential volatility, especially if it's a heavy weighted stock. So case in point, some of the ones on my radar, Exxon, for sure. Exxon's the number one weighted stock in the XLE. That's coming up on Tuesday. If I scroll down a little bit more, we've got quite a few this week. We have Pfizer, Lilly, Merck this week. Apple's on Thursday. Amazon's on Thursday. Google's on Thursday. Yahtzee. That's a big one, gang. So, I mean, other than the Federal Reserve on Wednesday, as soon as they're done, all eyes will be on what is Apple, what is Amazon, what is Google reflecting about earnings. That will not undo. I don't care what Apple says. It will not undo whatever it is that Powell communicates about the economy, about what their plans for rates are. So I will not say Apple's more important than the Federal Reserve this week. No way, no way, no how. Even in the trio of Apple, Amazon, Google, lots of volatility, but let's see what the Fed says on Wednesday. That's the week, gang. That's the big event of the week. All right, so let's go ahead and jump on into the charts and into the questions. Feel free to type them in, gang. I'll take them first come, first serve. And so first up is, before I get too far ahead of myself, we are about 2 weeks away from the first webinar that I'll be doing for the upcoming, For the upcoming TOPS masterclass. And I'll have a lot more about that coming up. But yeah, I'm very excited about that. So save the date. I don't have a registration page quite yet. I will very, very soon. But save the date, February 15, 8 p.m. All right, so let's get to it. Let's jump into those questions. And first up, all right, PP Family asks, we expect earnings to reduce year on year for most mega cap. I don't follow that stuff at all, PP Family. I appreciate the lead up, but I don't follow that at all. So I'll just take your word for it. Is there still a change for price to earnings expansion? Wrong person to ask, my friend. I don't follow it. It doesn't affect my trading. I'm not concerned about it. But what I can say is this. The most important thing we can do about any kind of fundamental analysis is ask ourselves, number one, what are we expecting to be affected by that? Which indices, which sectors, which individual stocks? All right, so what are we expecting to move based on whatever that may be? The second part is, are we expecting it to be bullish or bearish? Whatever the news is it a bullish catalyst or is it a bearish catalyst, right? So obviously something basic like price to earnings, whatever you're tracking. I don't track that, so I won't make comment on that. But whatever you're tracking, is that expected to be bullish or bearish? Here's the important thing. Is the market moving in that way? Remember, when it comes to fundamentals and any trade idea, being alone in the idea is never going to work. We need other people to either have similar bullish narratives, therefore they want to buy, or the same bullish narrative that we have, so they want to buy. So I'm less interested in what the different narratives are, especially fundamentals. I really don't pay attention to them really with any consistency. I like macroeconomic data, but I don't follow fundamentals. However, if that is being discounted, and that is something that we would anticipate is going to happen in the near term, we should already see support if it's a bullish narrative. We should already see resistance if it's a bearish narrative. We should already see evidence of that, because that means not just us, but other market participants are thinking something similar, right? So as far as those types of expectations, whatever that may mean, are the markets already moving in a way that's reflecting a growing belief in that? And that's the best way to do it. Let's see. Next follow-up is, would more investors be keen to put money into the Chinese market rather than the U.S. market? I don't think that's necessarily, it shouldn't matter if they're, again, investors from where. So you're in Asia. I don't know, my friend. I don't have the answer to that. I would presume that if the U.S. investor, and I can only speak from the U.S. side of things, being here in the U.S., KWEB would be a great place to start looking for that. And if we're, again, measuring whether or not traders and investors want to put money into names in KWEB, the answer is yes. And even more so, they are, right? So this is what I mean. The question is, would we be interested in, are we thinking that money might be flowing into ETFs like KWEB or even MCHI, right? And the answer is, I don't know until I look at the structure. And look at the structure there. PP family, look at the structure. It's heading higher. And this could be said of any symbol that we're curious about a narrative landing on. If the narrative is flow, I agree. We could even take another, because these are both ETFs, we could take another look at it through the inflows. Are we seeing steady inflows into these ETFs? But we definitely see the trend in play, right? I don't look at price to earnings, so I'm just going to skip that. So again, I hope the way that I'm breaking this down is allowing traders to not worry about whether a 9 PE means anything, whether an 18 PE means anything, right? Or more so broadly, where do we think money is going? And I think the trends will answer every question, whether that be fundamental or technical, right? Are we seeing the trends moving higher? All right. Okay. Next up. Hey there, Mark. Thoughts on XLF going from yellow to green? Maybe March call, 36 strike. It's a very fresh uptrend. It is going green. We've seen this before. We're above the 200. All that's great. I guess my thought, Mark, would be, do I want to prioritize XLF, right? So that earlier conversation about structure would apply here. But then my thought is, and I'm sure you thought of this too, Mark, the next question is, are we seeing other stocks within the XLF already in uptrends, more established uptrends? Citi, I believe Citi, JP Morgan, SPGI. Let's go take a look. So Citi, a little bit more established. Morgan, a little bit more established. JP Morgan, way more established. SPGI. So do you see that those four have a little bit better footing, a little bit longer, surer footing on the uptrend as compared to XLF? So I don't have a problem with XLF, but I would probably look to one of those four first. And then if JP Morgan continues moving higher, that bodes really well for XLF. So Mark, the fact that JP Morgan's moving higher does help. I'd prefer Berkshire Hathaway, Bank of America, and Wells join the party, but you've got 3 out of your top 6 in uptrends. And this is something that I teach definitely in the Sector Secrets Mastery, which is, hey, are we looking at the heavily weighted stocks in the sectors and asking ourselves really simply, is there more reason to be bullish rather than bearish? Is there more reason to think that the broader tide, the XLF, would move higher? And if the top 6 are moving higher, it's inevitable that it's going to continue to move higher. So I like the fact that 3 out of 6 are moving higher, especially JP Morgan. But maybe we want to look at some of those individual stocks, an individual boat, as opposed to the tide. So I hope that makes sense. All right. Okay, next up is, hey there, Mr. Walker. How are you? I'm late to trends. How does a working dude keep up and set alerts? Yes. So I think there's 3 things that we can think about as far as, okay, Rag, one of the most common bits of feedback that I get personally is, Rag, I'm going back to work. I don't have the luxury of time that I had, say, even 6 months ago, a year ago. I'm not trading from home. I'm going back to my job. And so then, the day trading that we've been doing since June, Rod, how do I day trade if I'm at work? And I'm going to be straight up. You don't, right? Unless you live on the West Coast and you're able to maybe day trade for an hour, 90 minutes before you go off to work. Or the hours that you work allow you to have access to maybe the first 60 to 90 minutes of the morning on, 9:30 to say 11 o'clock. And maybe that might be something that's an alternative. One of the things that Lorna and I have been testing, and I believe this started in June, was the 1 hour. And the 1 hour and the daily are going to become important time frames if the challenge is, I'm a working dude, right? what do I do? And I would say you've got to slow down the way in which the market needs your attention and the market needs your ongoing analysis. 1 hour charts means one new candle per hour. Slow enough and yet still quite actionable. The daily is something that I do believe anyone working full time or not has plenty of time to be able to take a look at one new candle per day, and the setups happen relatively slowly. So I think setting alerts would be really important, Mr. Walker. I completely agree with you. Maybe even more so than just simply setting alerts becomes the importance of, well, changing the time frame. Are we able to move away from day trading, which is something I don't think everyone has to do. But like I said, a lot of the feedback is, Rock, I don't have the time that I had. What can we do? What are the tools that we can use? And I'll say, let's start with a shift in time frame. And after that shift, I think you're going to be looking at a market that seems much more approachable, less intimidating, something you definitely could use to your advantage, right? Use the time frame to your advantage. All right, speaking of time frame, all right, let me go grab. So David, you want a little sneak peek on those DPMRs? Okay. All right, so a lot of you know we have daily price movement ranges coming, and these are not, this is something that's going to be complementing HPMRs, but if HPMRs are our day trading time and volatility tool, the DPMRs are our 1 hour, 4 hour daily time frame time and volatility tool. So it's less about is one better than the other, and it's more about which one do we use. It's a lot like comparing a hammer and a screwdriver, right? If I've got a bag of nails, I need the hammer. If I have a bag of screws, I need the screwdriver. So no one's going to disagree that you need both a hammer and a screwdriver. It's just, what are you trying to accomplish? And that's where we go to looking at the way in which the volatility in time sets up a 1 hour or a daily time frame with a different expectation for price movement, with a different expectation for how far price has to travel to reach those zones. Because we know that 5-minute day trading is really close. What if we slow things down? We also need to widen the levels to get better, accurate entries and exits. So anyway, those of you wondering, all right, at 1 hour, David, there you go. That's the DPMR right now on the S&P. Let me put that a little bit better on the screen for you. And that's what I'm dealing with right now. We've been open for about 21 minutes. That's the first hour that we're looking at. And you can see here, right, this is going to be the zone, but that zone will actually react to the new highs and new lows for the day. And it's supposed to. That's by design. That's by the design that I created for this tool. But that's what we got right now. Doesn't mean that's where they're going to be for the remainder of the day, right? Because volatility is dependent on understanding the highs and lows of the range and then projecting that accordingly. And without that adjustment, we're going to have inaccurate levels. And so, but that is where we sit right now. All right. Okay. Next up is, with rate hikes showing inflation seemingly to have topped, I think October lows was the bottom of this bear market. Hey, Charles. Yes, I'm not even going to hedge. Not only am I not going to hedge, anytime anyone says we're going to head lower, it's usually some ominous 3 months from now, 6 months from now, fall. It's some further out date, right? And good for them. They can see into the future. I can't. Not only, yes, but I said so last July. Now, who cares what I said then if you didn't know it then? But I really want to say that macroeconomically, and from a volume perspective, that's what I posted here on the channel. I'm consistent, right? I think a lot of times we can see traders and investors and commentary on television, right? It floats around with the breeze. If the breeze is heading one way, that's the way the commentary is going. The breeze turns around, that's the way the commentary is going. So I'm not here to tell folks what they want to hear, right? A lot of bears got really upset with me last year when I said it's ridiculous to keep expecting new lows to be shortable. I didn't say the market wouldn't go down, but I said, please don't sell at new lows. Please don't, sort of buy into the markets or, going to hell in a handbasket or whatever was promised, right? In July of last year, we bottomed out on volume. That's my V score. In July of last year, macroeconomically, there were enough shifts to fast forward. Federal Reserve now is saying, hey, we're about done. I'm not here to say whether that's right or wrong. I'm not here ready to argue whether that's going to be enough to tackle inflation. By the way, rate hikes are not what brings, and that's one of the mistakes a lot of folks make when they say, well, it's not enough to fix the inflation problem. That's not how, and I have a great image here. That is not how the Federal Reserve fixes inflation. It's actually they need to stop printing. Let me show you something. There we go. That's how inflation works. Inflation follows money, M2. So the rate hikes are part and parcel with less printing. As there is less M2 money supply, which is something we can track through the Federal Reserve themselves, they tell us what that number is. Inflation will then follow that. So the idea that we need higher rates, that's actually wrong. What we need is, sure, higher rates, but what happens along with higher rates? Less money printing. And that's really what the CPI follows, with about a 1-year lag. So to your point, those are things that we started to track. Volume was the first reason I said it's time to quit talking about lower lows and start to look at longer term portfolio buys and start thinking about oversold buys, not new lows mean we short into the abyss. That just hasn't worked. And so, Charles, a simple answer is yes, absolutely. And that's what I talked about in July. Not because I'm trying to prognosticate and predict, but because that's what the data led me to believe. Yeah. And notice I said data and volume, not price action. And I think a lot of traders who are trying to say we're going to head lower or higher for that matter, and are only looking at price, are looking at one of 4 factors. We should look at all 4 factors: price, time, volatility, volume. I looked at the macroeconomic rate of change, inflation, growth, jobs, and the Federal Reserve, the Fed Fund futures, and to track what I believe the Federal Fund was going to do based on what we could see. And then volume, right? Not even price. And I think that's really important because volume says what? Volume talks about size, right? Is it more important that we know a market made a new high or new low? Or additionally, would it be helpful to know as we were making that new high or new low, there was attention, there was commitment, there was participation. And I think all of us, when you think of it that way, you say, oh yeah, participation. Got it. That's really important. So Charles, I hope that makes sense. All right. Next up, Glenn says, can I go over CL after the pullback on Friday and what's going on with NG? So CL, let's jump on over there. So this is crude oil. By the way, for those of you that are slowly venturing into futures, and want to do more in the futures markets, please remember that one of the things that we can do as futures traders, and I know it's a very busy looking chart, so I'm going to actually undo the DPMR here. All right, one of the most important things we can do as futures traders is remember that there are micro futures, there are options on futures, and there are oftentimes ETF alternatives. So please be aware that futures are highly leveraged and full-size contracts may not be really the place to start, but maybe micros or options on those full-size contracts. I don't really see a lot of drama unfolding in crude at the moment. I wouldn't call that a pullback, my friend. It was a little bit weak, but we're not really going anywhere. So I don't look at crude as really anything I would do with it at the moment. I mean, that is resistance. Thank you, Darvis. It's overbought. Thank you, Slow Stochastic. We are still below the 200 propulsion. That tells me a lot about the sentiment around crude. But yeah, not a lot yet. to tell me that crude is ready to explode through the 200, but certainly breaking the downtrend, moving to a neutral environment, that would be step one. I would be more apt to buy an oversold crude oil market than I would shorting an overbought one, which is arguably where we are right now. As far as natty gas goes, it's straight up in a downtrend. Yeah, Glenn, thanks for asking. It's straight up in a downtrend. Yeah. Just moving lower and lower and lower and lower. So I am not yet thinking that it's time to do anything to the long side with natty. I know we're getting really close to a seasonal turnaround where we start to look for that rally going into summer. We're not quite there yet. But if it's in a downtrend, I'm not going to let the seasonal basically override the technical trend we see here. Seasonal and the technical trend have to be in alignment, and they're not quite yet. So nothing for me to do with natty quite yet. All right, next question and last question of our show. Mr. Murph asked, for Sector Secrets Mastery members, will the daily price movement range alerts be sent out on mobile app or only called out on the morning? Yeah, Mr. Murph, we haven't released them yet, but I have been slowly sharing. We've shared, 2 or 3 daily price movement range setups. One was in the NASDAQ, the other gold. We're slowly starting to, I'm letting the sector folks get a sneak peek on what Lorna and I have been working on for the better part of almost 10 months now. But no, eventually those will be alerted, because 1 hour trades, and a lot of you are going to learn a lot more about this. So this is intriguing. Again, February 15, I'm going to be diving into this. If the 1 hour is intriguing, it's a time frame that I haven't spent a lot of time on in probably, last time I was looking at a 1 hour pretty consistently, it was probably 2015 or 2016. I slowly started to move away from 30-minute, 1 hour, 4 hour, and focus on day trading, daily time frames, and the weekly time frames. And ultimately what we've realized through testing and just the market movement is the 1 hour's back. The 1 hour is working very well. And now I have a way to automate those zones that are working really well on the 1 hour. That said, yeah, probably after mid-month, I'll talk a little bit more about the 1 hour charts, and they will become part of the alerts that we send out, because there is a nice overnight quality to them. It is kind of slower, back to Mr. Walker's question. So while I don't believe in alerting day trades, these are not day trades. So yes, eventually, whether that be, it's probably going to be closer to March, because after February, probably sometime, I don't know the date. You know what? I shouldn't actually, the QQQ call was great. Thank you, Mr. Murphy. It was great. We'll talk a lot more about that on the 15th. I'm going to slowly do some more, but as far as when we dive into it, mostly probably sometime in March, but I'm not sure. I will definitely let you all know, and we'll definitely continue to do. We had another one on gold, GLD, Mr. Murph. We did that other one on GLD, which was another winner. So they're working pretty well. We'll lose eventually. I mean, this is not an infallible thing, but we will eventually lose. We just haven't yet. So I'm going to continue to walk you all through some of these setups, and hopefully this is something that's going to allow traders who don't have the time they maybe had in 2020 or 2021, the luxury of getting back into some longer term intraday, more nimble trading. I'm really looking forward to that. All right, gang. So I don't know if you're a Chiefs fan out there, a Bengals fan, or maybe you're one of those folks that says, Rod, I just don't care. I'll just watch the game, or maybe I won't. Whatever it may be, I hope you enjoy the rest of your evening. I will see you all tomorrow morning for charts and coffee. And again, if you haven't yet, the dates that we're talking about coming up, we've got February 15 and Saturday, March 4. So heads up. If you've been curious about the 1 hour charts, if you're curious about those DPMRs, you're going to love that webinar. We're working on it right now. Trish and I are putting the finishing touches on it. Lauren and I we've been comparing notes as far as what's worked and what's not worked for the past 10 months. I'm really excited to share this with you all. As always, gang, thank you so much for joining me for the Raghee Report. And I will see you all tomorrow morning at 9 for charts and coffee. Be good to each other, gang. Take care.